Hello everyone, welcome to another episode of Financial Tidbits here at NUF. Today we'll be talking about a red-hot IPO stock by the name of Oatly. Oatly stock IPO'd last week and its stock has been on a one-way trajectory with its valuation now beyond nosebleed levels. The counter is now valued at a market cap of close to 13 billion or a 26 times price to sales multiple. Compare that with similar peers in the industry such as Beyond Meat's 17 times multiple, and it's pretty clear that Oatly, as cheap as its name might sound, is an expensive stock to own. Take a look at Beyond Meat when it first IPO'd back in May 2020. Its price appreciated to an eye-popping $235 per share 2 months from its IPO. After all the hype has been done and dusted, its price collapsed back to $75 per share level by December 2020. Nonetheless, Beyond Meat's share price has risen more than 300% in the short 2 years since it was listed, and investors may well expect Oatly to be to plant-based dairy what Beyond Meat's been to plant-based meat. Consider first that less than 10 months ago, Oatly sold a 10% stake in the company to a group of high-profile investors such as Jay-Z and Oprah Winfrey for $200 million, valuing the business at just a paltry $2 billion. That $2 billion valuation has now skyrocketed 6 times into a $12 billion valuation. No wonder the rich keeps getting richer. For retail investors like us, the key here is, does it make sense to still be holding on to this richly valued baby? Rather than throw our hands in the air and feeling umbraged, let's examine what it could be that is driving investor enthusiasm in this business. First, let us consider the trend. Milk is on a downtrend. Back in 1945, the average American was drinking 45 gallons of milk a year. That figure dropped to 17 gallons in 2019. In terms of alternatives, we have got soy, almond, and oat milk as the 3 biggest competitors to traditional milk. Now, people are slowly transitioning towards plant-based products, first as a healthier option, and second as a more ecological friendly one, which explains the popularity of these alternatives to milk. However, not all plant-based milks are created with the same process. Do you know that almond, for example, requires 6 times more water to grow than oats do? How about soy? It will require a whopping 21 times more. So oat definitely has a lot less carbon footprint compared to other milk substitutes. And it is not just in regards to water, but also to the substantially lower amount of carbon dioxide produced during the production process. No wonder Oatly is bucketing the hell out of this fact. In the US, oat milk has already surpassed soy and is rapidly growing in popularity, and Oatly is a major driver of this trend. The company's US growth is a mouth-watering 182%, with Germany registering 199% growth and UK also up 99% over the past year. While these growths are coming from a low base, there's no doubt that the numbers are indeed impressive. Let's talk numbers for a moment. Oatly brought in $421 million in sales in 2020, up 108% year-on-year, and according to the Street's forecast, that figure is expected to rise to $800 million in 2021, another close to 100% growth. If Oatly can indeed achieve such a revenue growth in 2021, then the market is looking at a forward valuation of just 16 times price to sales at current prices, which is roughly in line with Beyond Meat's valuation. The big question then is, can the company continue to generate such hyper sales growth beyond 2021? Because that is the key reason that is supporting its nose-bleeding valuation at present. If one believes that with its US listing, the company will now gain greater recognition and thus could sustain its 100% type revenue growth rate, then it might be worth taking a punt at present, even though the road to profitability is still miles, or should I say years away. On the risk side, there are already a number of big-pocketed competitors out there with products that people love, and such robust industry growth will inherently attract new entrants. That and major retailers such as Walmart pressuring them to reduce prices, and we could witness margin squeeze. Let's not even go into the possibility of a sustained hike in raw material costs due to inflationary effects. Is Oatly going to be a powerful brand where everyone in future associates them as a healthy milk option, or is it just a commodity wrapped in a shiny box? I don't know, but personally, when it comes to the taste test, it does taste like shit to me. And the company is not afraid to market the hell out of it. Kudos to that. At present, interest is definitely overinflated, and I do expect a Beyond Meat-like cool-off after a couple of months of media hype, since it is the only publicly traded pure play in an exciting sector. It has certainly captured my curiosity, and I'll be waiting for the right time to pounce on this eco-friendly product that certainly tastes like shit. Now is just not the right time. Once again, thanks for tuning in to another episode of Financial Tidbits here at NOF. If you enjoyed the video, do hit the like button and subscribe to the NOF YouTube channel. Once again, this is Royston signing out.